Thank you so much, Jonathan, and thank you so much to the AAMC First program for allowing us to come in and speak on home financing for graduating medical students and residents. All right. So I am Matt Tobel with Huntington Bank Physician Loans, and that is at physicianloans.com. And we're really happy to be part of this course again and happy to be hosting the session. I want to share a couple pieces of information just in case anyone is not comfortable putting into the Q&A any of their questions. I know that there's a lot of nuances with mortgage and home lending and credit questions. So my contact information is right here as well as my phone number. So you can ask me questions before or after, and the Q&A is open with Michael monitoring that. So I do work for a bank. Huntington is a bank, so we do have to go over a couple disclosures. And I do want to start by saying that this is not a sales presentation, and Huntington does not have any financial ties or any material relationship with the AAMC. And this intent of the workshop is to educate you on long-term financial health and literacy because this association recognizes that it's valuable to have this information made available to you. Any future business between you and Huntington is at your choice and consent. And there's absolutely no obligation to apply for any products after attending this session. I'm just here for your educational benefit. I don't even originate the loans, so you can feel comfortable asking us anything that you need to. So why am I here? I'm here to educate you about home buying as a new doctor and to provide considerations for you to determine if buying's right for you and what steps to take if you're interested. I'm not here to tell you that you need to buy a home or that you should buy a home. And for some of you, it's just not possible right now. And it's just not the right choice in your timeline. So what you learn here today can help you when the future for buying is right for you. So we're planting the seeds of what you can later use. We're going to cover a variety of topics, and this session is not only pitching homeownership. It's to help you navigate the path if you choose, because it's a complicated one for graduating medical students and for residents. So we're going to move through an agenda of why are we here, understanding credit and credit scores and mortgage, buying or renting, how much can I afford or pre-approval, loan types, timelines, a closing budget, and also some real estate market updates. And again, ask those questions throughout. So how did we get here? We're going to talk about the housing shortage. And the 2008 financial crisis, known as the Great Recession, was the most severe economic downturn since the Great Depression. And it began in the United States and it spread worldwide, causing massive job losses, foreclosures, and a sharp decline in household wealth. The crisis stemmed from a housing bubble that was fueled by low interest rates, lax lending standards, and decades of financial deregulation that weakened risk management markets. And when housing prices fell in 2006, mortgage defaults surged, and that triggered widespread instability. And by 2007, major subprime lenders collapsed, and there was the failure of two major investment banks that froze credit markets and created a global liquidity crisis. The US government responded with some pretty unprecedented measures, including the Emergency Economic Stabilization Act, which authored a $700 billion bailout, the Housing and Economic Recovery Act to stabilize mortgages, and the American Recovery and Reinvestment Act, which provided stimulus through spending and tax cuts. And then in 2010, the Dodd-Frank Act overhauled financial regulation and created the Consumer Financial Protection Bureau, or CFPB, which increased regulatory oversight and consumer protections. The Great Recession led to millions of job losses, widespread foreclosures, and a stock market decline of 50% between late 2007 and early 2009. And it exposed systemic risks in the financial system and sparked ongoing debates about regulation, government intervention, and the fragility of global markets, all effects that continue to shape economic policy today. And these effects have shaped today's mortgage and lending environment by prioritizing thorough documentation, verified ability to repay standards, transparent disclosures, safer loan structures, and longer and stronger regulatory oversight. So what does that all mean? Developers and home builders went out of business after this time, and not enough homes were being built. This was also exacerbated by corporate investors buying homes pre-COVID. During 2020, fewer owners put their homes on the market because of the pandemic and social distancing. And then between 2020 and 2022, it was a very low rate environment and very low inventory environment. So it was a seller's market. In 2023, there was still a tough market due to low inventory and homeowners now having very low interest rates on their current homes. And that's referred to as the lock-in effect, where people are locked into low rates and not interested in moving. Between 2025 and 2026, there's pressure to lower rates from the current administration, having been above 6% for over a year, with real speculation over the last 2 years or 2.5 years of rates talking about dropping. So, what does all of this mean for you? We can begin the process early. It's more important than ever to work with a trusted loan officer and a trusted real estate agent to handhold through the process. And we can enter the process with an informed mindset. And like I said, we're planting the seeds today to do that. We're going to talk about understanding credit in mortgage because it's a very important part of being pre-qualified and your mortgage application. So your credit score can impact your ability to get a loan and the terms, like your interest rate. And understanding your credit score is a real critical piece of all of your financial health. Most of you likely know that it's a number that summarizes your credit risk, and it ranges anywhere from 300 to 850, and it's calculated from credit accounts and other data on your credit reports from three major credit bureaus, TransUnion, Experian, and Equifax. And lenders use this to determine loan terms. And lenders will typically average all three of those because they can be three different scores, and that's the score that they will use, the average of the three. Your credit score, when looking at this pie chart, you'll see is made up of several components, the largest of which at 35% is your payment history. And that's a really important factor because it tells if you've paid your loans or your credit cards on time or you've missed payments. The next is the amounts owed, and that's 30% of your score, which is outstanding balances and how much you owe relative to how much you've borrowed with the accounts that you have with current balances. And it can also be called credit utilization. Next is the length of credit history, and that's measured at 15%. And this is the average age of the accounts in your credit report with the oldest and the newest, and those are all considered. We also have credit mix, having a mix of revolving and installment credit accounts with balances that show that you can manage different types of credits. And with a revolving credit, that's similar to a credit card where you're paying that off monthly. An installment credit would be something more like a loan where you're making installment payments on that. And last but not least, we have recent credit applications where applying for new credit accounts can lead to hard inquiries. And hard inquiries are when a creditor is requesting a copy of your credit report. And if you have too many hard inquiries, that can bring your score down too. So how do all of these things with credit score affect your ability to secure a mortgage? So the first that we're going to talk about is a mortgage approval. And higher scores usually increase your chances of being approved for a mortgage because lenders see a high credit score as an indicator of responsible credit management and overall lower risk. Lower scores don't automatically disqualify you, but you could face stricter requirements or be directed more towards more specific loan programs. The next we'll talk about will be interest rates. And higher credit scores often lead to lower interest rates, and that can save you thousands of dollars over the life of your loan. Lower scores are associated with higher interest rates because lenders are trying to mitigate that perceived risk of lending to you. The next are loan terms and requirements, and this is broken down into three categories, as you'll see, the first being down payment. Lower credit scores could necessitate a larger down payment to offset the lender's perceived risk. The next is loan to value ratio, and your credit score influences the maximum amount that you can borrow relative to the property value that you're looking at. And lower scores might limit that loan to value ratio, meaning that you'd likely need a larger down payment. The last is mortgage insurance. And if your down payment is less than 20%, you'll likely be required to pay private mortgage insurance or PMI. And we'll talk more about private mortgage insurance later in this presentation. But when you're paying PMI, lower credit scores can increase the cost of that. So those are all ways that your credit affects your ability to get a mortgage. Last but not least, about credit, I do want to say that you can visit annualcreditreport.com for a free credit report from each bureau, Equifax, Experian, and TransUnion, once per year. And this isn't going to give you your score, but this is going to go ahead and give you a report of what these bureaus are seeing and reporting on. So you can understand if there are discrepancies or maybe a card that's opened that you didn't authorize, and you can utilize that to either bring credit scores up or just really be monitoring your credit overall. Next, we're going to move into buying or renting. And I see some of the questions coming in with Michael answering those. So awesome job using that, everyone. And when we talk about buying and renting, we're going to try to understand, is buying even an option for me? And when we're thinking about match or we're thinking about even finishing residency, there are a lot of markets where renting just makes sense when compared to the home averages that are there and the pricing that's there. So when we're looking at everything, we want to consider it with these two different diagrams. And you'll see that how much you qualify for, comfortable monthly payments, and local home prices are all of the sets of these Venn diagrams. And we see one where everything is intersecting, and we see one where local home prices is outside of how much you qualify for in comfortable monthly payments. So the one with everything intersecting is likely going to be an option for homeownership or purchasing a home. Where local home prices are outside of how much you'd qualify for or comfortable monthly payments, that's likely going to be more of an opportunity for renting. And we're going to talk a little bit more about how to get into this position because you'll need the help of two different professionals. One, being a lender or a mortgage loan officer, and two, being a real estate agent or a realtor. A mortgage loan officer can help to know to the penny what you'll qualify for and walk you through your income, your debts, and all of your financials. And just to note, they're only paid when the loan closes. So when you're meeting with them, you're not paying them like weekly or monthly or anything. They are compensated when the loan closes. And then understanding what local home prices are because the mortgage loan officer is going to help you with the how much you qualify for and comfortable monthly payments. We go to the real estate agent or realtor for local home prices. And in today's world, a lot of people are looking at Zillow or Redfin for home prices, and that's great to begin your search. But a realtor is going to really drive that down, whether it's zip code or neighborhood that you're looking at. There can be pocket listings that aren't online. And that realtor walks you through the entire process of buying and selling and really holds your hand. And they're usually paid a 3% fee, but that's when the process is completely done and the home sells. And they ensure that's done without really any hiccups that you're coming into. And if you don't end up buying a home or end up doing a mortgage loan with either loan officer or real estate agent, you're not paying them anything. So why is this step important? You can find out that you might be able to qualify for comfortable monthly payments, but local home prices could be outside of the reach of what your purchase power is. So renting could be one of the only options to where you're moving. And keeping in mind that many communities, like we talked about earlier, have low inventory and they're still seller markets. And you're also moving at a time when there are a lot of other people that are moving for match, and we're moving into the busier home buying season with the late spring and summer and a corporate relocation season. So it's an extremely competitive marketplace. So walking through with two professionals and the guidance that they offer is definitely something that you can start on the right foot with. We want to also talk about common decision factors that you can speak to your realtor and your mortgage loan officer about. And we're going to talk about location, we're going to talk about time and home, we're going to talk about lifestyle, and also the financial benefits. So when we're looking at the location, this is actually FHFA.gov. It's a table that is on this website, and it's a government website where this group has been tracking home values across the US since 1991. And it's a great starting point, for an understanding about really what's happening in a marketplace. This list that you see from 1 to 12 on here actually goes to 100, and it's the pricing indexes that change year over year. So with this 9.7 year over year for Allentown, that is an extremely hot market. And a lot of these that are in the top 10 are going to be hot markets where we can experience more competition and really understand that those markets may be a little bit more out of reach for home buying. And when we look at this, we can understand local market trends and really compare regions. And it's a good starting point that you can bring up with a real estate agent so that they can drill down pricing even more because these are just the year over year changes. Your real estate agent can help you get information by zip code or neighborhood. And it's really a great start to be able to gauge differences in housing affordability in specific geographic areas. So even if you may be moving to one of these cities or areas, there could be more affordable areas that are just right outside of that. And for some of the areas that you may be considering moving, renting may only be the possibility that you have. There are some markets that will just be out of reach to purchase a home, and some markets where inventory will still be an issue too. Next, we're going to talk about time and home. And with the map that we see on here, again, this is fhfa.gov, and this is a heat map of where we see appreciation. And it's generally assumed that real estate appreciates over time the longer that you're there. So if we're thinking of staying anywhere less than 4 years is what we used to say, it's actually above that now. It's closer to 5 to 6 years. You're likely not going to see any benefit in owning a home due to the selling costs of that. So if we're doing research positions or residencies that are going to be under 5 years, it's likely more of a viable option to be renting for those because when you sell your home, there are costs associated with that. And this map shows us the appreciation across the US by 4 quarters. And it helps us understand where housing markets may be heating up or cooling down. So the areas that we see on this map, all of the blue are areas that have been appreciating. The areas that are going to be the warmer colors are areas that we're seeing depreciation or some of the pricing that is actually coming down. And when we notice those areas, we're also going to see that a lot of them were real hotspots where pricing spiked during the pandemic. So the pricing coming down really means that those markets are just cooling. Lifestyle is going to be one of the most important factors we talk about going into residency because it's a really important step to talk to your realtor about. When we talk about what's important to you and what your lifestyle is like, renting is always going to be a more convenient option in terms of responsibility and maintenance. Homeownership requires a lot of maintenance, and there can be different factors that a renter just wouldn't need to take care of. A renter isn't going to need to worry about a roof or snow removal or a lot of the things that a homeowner would, and they can utilize their landlord for a lot of those. So time being convenience is one of the factors that we really want to think about if you're working long hours or a few days in a row, anything like that. What is the price of your time off taking care of the home that you're in? It's likely that you may not have a lot of that time, and the convenience of renting could be more of a benefit for it. So understanding that the time portion is one of the biggest for lifestyle is something that you want to talk to both professionals about. You can also understand, do I want to live in an apartment or a condo, which could be easier for convenience of not taking care of a yard or maybe having amenities in the building like a gym or services like package reception. It could just make your lifestyle easier. And all of those as opposed to a single family home where you're taking care of all of those yourself and may not have a lot of those on-site amenities too. So thinking about lifestyle with your schedule is a really large step of talking to both professionals. And the last that we're going to talk about the common decision factors will be financial benefits. And for financial benefits, what we want to understand are that there are renter benefits and there are homeownership benefits. There will be more homeownership benefits though financially. So when we look at renter benefits, What we want to consider is the time commitment for maintenance and upkeep, like we talked about. Time is money. You can also build credit with a financial benefit of renting. There are newer programs. One of the bureaus that we talked about earlier, Equifax, is actually doing a boost program where you can utilize your rental payments to go ahead and set up and build your credit, which in the last 5 years hasn't been something that really has ever been taken into consideration for bureaus tracking credit and rental payments with that. And when we want to think about some of the larger landlords that are starting to do that too, it's a financial benefit for renters being able to build their credit with those larger payments. You also have some of the freedom to personalize within reason, according to your lease or your landlord. And one of the largest ones is a lower upfront cost. You'll only have a security deposit or maybe an administrative fee as opposed to a down payment. Now, when we talk about the homeownership benefits, the first one we want to talk about is building equity, because you will be building equity with every mortgage payment that you make, which you do not get any equity being a renter. So when we talk about home equity, that is the portion of the mortgage that is the part you really own. And it's calculated by taking the current market value minus what you still owe on the mortgage. And it grows as you pay down your loan and your home value increases. So another benefit is home value appreciation. There's also predictable payments and stability in a lot of mortgage payments. You have the freedom to personalize because you own the home. And we have different access to products that tap into that equity or that home equity we're talking about. So one is a home equity line of credit and another is a home equity loan. So when we think about those, a home equity line of credit works like a credit card. The bank gives you a credit limit and you can borrow what you need when you need it and only pay interest on what you're using. And it usually has a variable interest rate, meaning that that can change over time. In contrast to that, a home equity loan gives you a lump sum of money up front, which you can repay in fixed monthly payments over a set period. And typically, a lot of these are going to be used as tools for large expenses like a home renovation or college tuition, paying down debt consolidation, anything like that. Next, we'll talk about investment. So your forced savings with the principle of building that equity. And we have three different tax benefits. So a mortgage interest deduction, property tax deduction, and capital gains exclusion. So all of those are homeownership benefits that we'll see that we wouldn't see with renter benefits. And last but not least, I would like to talk about interest rate fluctuations because refinancing is an option if the rates lower in the market. And when you refinance at a lower rate, it's a financial benefit because you're paying less money per month and you can utilize those funds elsewhere if it's savings or if it's towards anything that you have in your financial plan. So those were all of the common decision factors between buying and renting that you walk through with both of those professionals. I see some of these questions coming in with Michael taking care of those. So thank you for utilizing that so we can keep on moving through the presentation. Next, we're going to talk about how much I can afford or pre-qualification. And this is when we're starting to get into more of the process of home buying. So the first thing we're going to talk about is the 20% rule. And it's a general rule of thumb that 20% of the purchase price is typically used as a down payment for a home. And if you put down under 20%, you can be approved by loan types, but usually private mortgage insurance is usually required. And we talked about that earlier, PMI, because your credit can affect that. So what is PMI? PMI is a policy that protects the lender against losses if a borrower fails to repay their mortgage. And PMI does not protect the borrower. Instead, it mitigates the lender's risk associated with lower down payments. And PMI is a monthly cost. So it's part of your housing payment. And you pay that until the equity in your home hits 20%, and then it can roll off. Some lenders automatically allow it to roll off. Other times you'll need to reach out to your lender, letting them know that you hit 20% equity. But do know that certain mortgage products and loan types can assist with down payment options, and some of them can even waive private mortgage insurance. And we'll talk about those when we're discussing loan types. So how much you qualify for is really determined by your debt to income ratio, or your DTI. And your DTI is a ratio of your monthly debt payments divided by your gross income. And what this tells a lender is a borrower's capacity to take on and repay debt. The higher that it is, the lower that borrower's ability is to service new debt. And it's really primarily used in mortgage and some consumer lending loans. And it's really important to understand this because different loan products have different um, different requirements for this. And with dual applicants, when we want to talk about maybe moving in with a significant other or purchasing a home with a significant other or a spouse, dual applicants can help increase your monthly income. It does also increase monthly debts, but when you have dual applicants, it can increase monthly income and increase how much you can qualify for, so increasing your buying power. When we talk about these DTIs, we also want to think about the different products that DTIs allow for. So we're looking at these different products right now: physician loan, conforming loan, FHA loan, and VA loan. And we'll see all of the different thresholds of debt to income that are allowed. And don't think that you need to know everything about these. We're going to talk about them in more depth. But what I want you to pay attention to is that there are different DTIs allowed for each one. So a physician portfolio loan allows for 50%, so 50% of that debt to income. Conforming loans allow 36%, FHA loans allow for 43%, and VA loans allow for 41%. So they're all allowing different amounts for that DTI. And a physician loan is the one that is going to be offering the most flexibility with that at 50%. And when we want to look into that more, we'll look at all of the different monthly debt payments, and we'll have a car, an auto loan, we'll have credit cards, we'll have a housing payment. And the most significant one that is taken into consideration with a physician portfolio loan is going to be the student loan payment and how student loan payments are accounted for. And that is why the debt to income ratio for a physician loan looks different and higher than those other mortgage products that we saw. And when we when we think about this, we can think about the the foot like the footing that you're on right now. This is going to be able to set you up for a product that understands where you're at in your life and understands that a graduating medical student is likely going to have a higher cost of student loans than typical borrowers. So with your new medical degree, you qualify for a physician loan program, whereas those other products aren't going to be quite so flexible with the debt to income ratios. When we talk about housing payments and when we're talking about the process of home buying, we want to think about a housing payment as something called PITI. And when we talk about PITI, I know that there's already a lot of acronyms, but here's another. It's principal, interest, taxes, and insurance. And principal is the sum of all of the money that you borrowed. Interest is a fee being charged by the lender for lending money. Taxes are annual or semi-annual charges that are based by local governments or jurisdictions for owning real property. And insurance, it protects against damage and liability. And all of those are bundled together into your housing payment, your PITI. And the only additional thing that could be another monthly payment could be, like we talked about, private mortgage insurance if you have a down payment that's under 20%, or an HOA fee, or maybe a condo fee that sometimes could include things like landscaping or utilities or services for specifically that property. When you talk to a real estate agent or a mortgage loan officer, they can help you understand if there are HOA or condo fees that will be additional monthly costs. And when we think about PITI, we're going to look at it with a $290,000 house And we're going to assume that this is around a 7% interest rate. And we'll look at the principal, interest, taxes, and insurance all being bundled together into a $2,220 total housing payment. With your principal and interest, this is always going to be the largest component of your housing payment. Here we see that it's $1,929. Your taxes and your insurance are always going to be bundled together too. We'll see 241 here and 50 for the insurance. And taxes and insurance are bundled together and they're accumulated for you by your lender and put in something called an escrow account. And an escrow account is a secure lender managed account that collects all of your insurance and your homeowner taxes. And it protects a lender by ensuring that those are paid for and paid on time. And it acts as a savings mechanism, preventing borrowers from making large lump sum payments at a time that taxes or insurance are due. So your mortgage lender is collecting your taxes and your insurance for you, putting them into something called an escrow account and paying them for you. That's why we break it out from the principal and the interest. And when we look at PITI comparisons, we can see that here, a $225,000 home is going to be cumulatively 1,724. We'll see the mid-range of what we just talked about with that $290,000 home being right around 2,220, and then 450,000, which is closer to where the national average of homes are right now. We'll see that housing payment be closer to the 3,439. And these are all estimations, but what I want to really focus on here is that your principal and interest is always going to be the largest component of your housing payment. Your taxes and insurance do change relative to what the cost of the home is or the cost of the loan that is being taken out. And with this, your principal and interest are always going to be the biggest component of that. And it's important to understand that because of the way that a mortgage works. And when we look at the way that a mortgage works, we're going to take a look at this chart. And this is a full 30-year mortgage amortization chart. And it shows how principal and interest payments change over time during the course of that loan's life. And amortization is the process of paying off a home loan over regular monthly payments through time. And each payment is split into the two parts that we've talked about, the interest and the principal. And early on in the loan, most of the payment goes towards interest. But as time goes on, more of it goes towards reducing the principal, which is what we see in this chart. We see that over the life of the loan, your principal is going up and the interest payments are going down. And at one point, they even intersect. And this structured repayment plan ensures that a mortgage is fully paid off by the end of the loan term, whatever that is, 15 years or 30 years. And understanding amortization can help you see how long-term loans work, but also can help you understand how making extra monthly payments can reduce the total amount of interest that you pay. So an example that's below here, let's say we take out a $200,000 mortgage for a 30-year fixed loan and it's at 6%. If we add to the monthly housing payment an extra $200 a month, that loan normally would have taken 360 months or 30 years to pay off. But that $200 additional payment per month, the new payoff time would be 252 months or only 21 years. And it would save a total interest amount of $79,800. So making additional payments because of the way that a mortgage works and making additional payments to that principal can drastically affect the amount of interest that you're paying. And for someone in your shoes, that could be a benefit further down the road of paying off a mortgage much more quickly and saving money from interest that you have saved yourself. All right. Questions are still coming in. Awesome. Thanks so much, Michael. So next, we're going to talk about the types of loans. And when we think about the types of loans, there's a lot of different products and a lot of different types that are going to be out there. What we want to start by thinking is about a fixed rate mortgage. And this is probably a mortgage that you're more familiar with. This is where principal and interest payments are fixed for the duration of the loan. And it creates stability and easy budgeting. So your principal and interest are always going to stay the same. The only things that can really change are taxes or insurance because taxes and insurance can be variable and fluctuate. Um, when we want to think about fixed rate mortgages, there is more of an interest rate premium for that stability and easier budgeting too. But they come in a variety of different terms. So you could do a fixed rate mortgage of 15 years, you could do one of 30 years. 30 years is the most common, but they come in a variety of terms. Next is an adjustable rate mortgage. And an adjustable rate mortgage has payments increase or decrease based on index and margin. And typically, you have a lower initial interest rate with a lower initial monthly payment that can increase after a specific agreed upon term. And there are a variety of adjustable rate mortgages. There are 3-year ARMs, there are 5-year ARMs, 7-year ARMs, and all of them with that initial term of 3, 5, 7, or 10. After that period, that rate can adjust and it is capped. So your lender will have a cap for it, but it adjusts based on the index and the margin. So sometimes adjustable rate mortgages are popular with people who understand I'm only going to be there for 5 years, or I know I'm going to be there for under 10 years when they're buying a home. So they take advantage of the fact that it may be a lower initial monthly payment and a lower initial interest rate for that term that they know that they'll be there. Adjustable rate mortgages do have a stigma, though, in the sense of societal terms, because there's not the certainty that a fixed rate mortgage has with the stability and easy budgeting. Now, when we talk about other loan types and these products that are below them, we're going to talk about a physician loan, which is what the webinar is really all about. And a physician loan is a portfolio type loan. And Huntington Bank is not the only lender that offers a physician loan or a portfolio loan. But when we talk about physician loans, in the context of this webinar, I want you to understand that all of the benefits that we talk about for a physician loan are important to ask a mortgage loan officer. Make sure that you're getting every single benefit that a physician loan should offer, because there are going to be a lot of lenders out there that call something a doctor's loan or a physician loan that may not have all of the benefits that we're going to discuss. So a physician loan is a portfolio loan, and a portfolio loan is a special loan product that a bank keeps on its own books rather than selling to investors in the secondary market. And these loans offer flexibility for borrowers with unique financing profiles, typically featuring tailored underwriting terms. So a physician loan is a portfolio loan because it's specifically for people with certain medical degrees. Next, we're going to talk about a conforming loan. And a conforming loan is a mortgage that meets guidelines that are set by Fannie Mae and Freddie Mac. And those are two government-sponsored enterprises that buy and guarantee most home loans in the US. The main rule of thumb is that the loan has to be within conforming loan limits, which those are updated every single year by the Federal Housing Finance Agency. And for example, the limit this year is closer to 832,750, and that's for a single family home. It can be higher thresholds in more expensive markets. Conforming loans require borrowers to meet certain credit patterns, income, assets, and debt to income ratio standards. And because these loans follow strict rules, they usually have lower interest rates, and it makes them a really popular choice for home buyers. Next is an FHA loan. And an FHA loan is a type of mortgage insured by the Federal Housing Administration, FHA. It's designed to help people who may not qualify for a conventional loan, such as first-time homebuyers or people with lower credit scores. FHA loans typically require smaller down payments, which can be as low as 3.5%, and they have more flexible credit requirements. And because the government backs these loans, it makes lenders more willing to approve borrowers that have less than perfect credit. FHA loans usually do require mortgage insurance, especially if you're putting down under the 20%. So if you use that 3.5%, you will have an additional cost of the PMI every single month. and they're popular for making homeownership more accessible for a wider range of buyers. Next, we're going to talk about a VA loan. And a VA loan is a mortgage that's backed by the U.S. Department of Veteran Affairs, hence VA. And it helps eligible veterans, active duty service members, and some surviving spouses buy and refinance a home. The biggest advantage of a VA loan is that it usually requires no down payment and waived private mortgage insurance. So it makes homeownership much more affordable for VA applicants. And VA loans also tend to have more competitive interest rates and flexible credit requirements when you're comparing them to conventional loans. The only downside is that there is a VA funding fee, which can be financed into the loan unless they qualify for an exemption. And these loans have all of these particular benefits because they're designed to honor and support those who have served um, in the military and make it easier for them to own a home and plant roots after service. So that's a lot of information. And what we want to do is look at all of these mortgage loan types in more of a beneficial way, especially with what we're going to talk about with the physician loan being a portfolio loan. So when we talked about all of those benefits that we just went over, we want to think about the benefits that are going to be in the column that is furthest to the left here with me. And we're going to talk about all of them in context with the different mortgage loan types. So when we go into down payment, we want to think about a physician loan portfolio loan is offering as low as 0%. A conforming loan as low as 3, FHA as low as 3.5, and VA as low as 0. So all of them have flexibility with down payments. And keep in mind, when we talk about physician loans, Huntington is not the only one that offers a physician loan, but you want to make sure that you're getting all of these benefits because all of these benefits should be available with a real physician portfolio loan. Next, we're going to talk about student loan documentation and the flexibility that's around it for a physician portfolio loan. With student loan documentation, typically what all of the lenders are looking for is going to be 12 months of your payment history for student loan documentation, what you're paying on that loan, and 12 months of the history for it is something that you're not going to have. So there's flexibility for a physician portfolio loan with those underwriting standards because we understand where you're at. And any lender that's doing a portfolio physician loan is going to understand where a resident or graduating medical professional is at too. With student loan documentation flexibility, it can be as much as assuming income-based repayment plans, things like that. There is much more flexibility about the documentation that you can provide to be qualified and pre-approved for. There's also no mortgage insurance for a portfolio physician loan. A conforming loan and an FHA loan would require private mortgage insurance if you're putting down under 20%. So keep that in mind. And for a VA loan, they actually do waive private mortgage insurance for veterans. So that is a benefit of VA. Next, we're going to talk about fully executed employment contracts or offer letters being accepted because all of these other loans, aside from the portfolio physician loan, will be requiring typically W-2s. They're going to be looking for 2 years of W-2s or pay stubs, assets, anything like that. And generally speaking, employment contracts or offer letters are not going to suffice for what the threshold of pre-approval is. And for a portfolio physician loan, we can look at fully executed employment contracts and pre-approve off of that. Usually looking for W-2s and pay stubs is going to be what a mortgage loan officer works with for conforming FHA or VA. And if they do allow any type of executed employment contract for conforming FHA or VA, they may be accepted, but there's always going to be non-contingent offers like background checks or medical licensing. And if you don't have those things completed, you're not pre-approved for your loan or for closing yet. So there's more flexibility for a physician portfolio loan here. We talked about higher debt to income ratio allowed at the 50%, but FHA and VA did have higher debt to income ratios allowed rather than conforming. And closing up to 90 days prior to orientation, residency, job start. So with that, what we want to think about is really where we go from 90 days prior to orientation, we're going to be moving into this home prior to starting our job, which is going back to what the income verification is. Most of these loans do not allow that. So when we talk about closing up to 90 days prior to orientation, getting settled into where you're moving, there's more flexibility with a physician portfolio loan when we're looking at that aspect. Some other programs with mortgage types can allow that, but there's much more flexibility with a physician portfolio loan. So why is applying for the right loan important as a graduating medical student or resident? We want to talk about the little to no savings, which helps with the down payment, student loan debt, which we're going to have flexibility for that documentation most lenders will look at, no proof from the lender for student loan payments for the next 12 months, which ties right back into that, and the debt to income ratio for student loan debt being higher at 50%. Job starts in July, but you want to move sooner, so that 90 days. This is going to help with you being able to get acclimated to the community you're moving at before you start your residency. We don't have income verification for the residency program that we're going to because we don't have a W-2 working there or pay stubs yet. So there's flexibility with that. And there's no contingency with medical licensing yet. So there's flexibility there being in the offer letter and having those contingencies be met with working with a physician loan lender. And it's important when we're talking about all of these benefits because all of the underwriting that goes into a portfolio physician loan is made specifically for someone who's in your shoes. There are a lot of hurdles and complexities of home buying, and it's even harder for a graduating medical student and resident or early career physician to be moving into this space and be pre-approved or qualify for a mortgage. So a product that is a physician loan or a portfolio loan that's made for you is the first step into homeownership that can really help you on that path. We're going to talk about what the timeline is, and I did see a lot of questions come in for Michael um, regarding really about that physician loan. So that's awesome that we're answering some of the questions in the presentation and also getting those answered thanks to him. Thank you, Michael, and thank you all for asking great questions. We're going to talk about the home buying timeline next. So when we think about the home buying timeline, we want to think about the first step being in January. And I understand that right now we're in the middle of February. So when we're looking at a timeline, it can be flexible. This is just suggestive for match, and all timelines can be different. But the first steps can be done anything before that match day period. And when we think about that, we just want to think about all other residents that are considering home buying. They're going to be looking right around the same time as match day when you understand where you're going. So just keeping in mind that there's a large fluctuation at that time really gets the gears going about what this timeline looks like and how you may be able to be pre-approved. So the first step is selecting a loan officer and getting pre-approved. And it tells you how much you can borrow before you start working with a realtor. And it shows sellers that you're a very serious buyer. So to get pre-approved, you complete an application with a mortgage loan officer and provide financial and credit documentation and answer questions about income and expenses. And once you're pre-approved, you get something called a pre-approval letter. And that strengthens your negotiating position and allows you to make offers firm and quickly. So if you do find a house and you don't have a pre-approval letter, you'd have to go through all of that process and you could miss out on the house. Next, you can select a realtor to work with who will help you find a home and handhold you through the whole process. You should interview and ask them questions that are important to you, sharing goals, timelines, and must-haves. And in some states, you will need to sign an agency agreement. After finding a home, your realtor will help you negotiate not only price, but things like possession date and closing costs. And then you provide something called earnest money. And earnest money is a down payment or a good faith deposit that you give your realtor when you're in the process of presenting an offer to purchase real estate. And your realtor puts these funds in an escrow account and holds on to them when your offer is being considered by the seller and his or her agent for acceptance. And the next step would be once your mortgage loan officer has completed your loan application, they provide you with a loan estimate. And this gives you all of the estimate of costs associated with your loan. And it's a document that provides an estimate of funds that you'll need to bring to closing too. Next, a home inspection is coordinated by your realtor, and a home inspection is conducted to ensure that a home is in good condition. So the HVAC system, interior plumbing, electrical systems, and every structural component is reviewed, and a written report with details is provided. And if there are concerns or fixes needed, your realtor will help you negotiate what needs to be fixed and by whom. After the inspection, your bank or your mortgage loan officer will order an appraisal. And the appraisal is an unbiased professional estimate of a property's fair market value. And it's typically required by lenders during refinancing, mortgage, or any type of sale to ensure that a loan aligns with a home's worth. And it's a licensed appraiser that comes out and they evaluate everything from home condition, size, features, and they compare everything to similarly sold properties in the area that the home is that you're looking at or putting an offer in. Next, your mortgage loan officer keeps you informed during all of this process. And during that time, it's really important that you get everything submitted on time because any even slight delays will be able to postpone closings. And processing can be significantly impacted by not providing things on time. But hopefully at that point, your mortgage loan officer would receive a clear to close. And that means that you've made it to the closing table. And this is typically anywhere about 60 days after we've moved from the initial start of like finding the home, everything along those lines. And we said it's suggestive, so every single timeline can be different. But moving at this stage, you'll go ahead and you'll review all of the documents for accuracy and stay in regular communication and contact with your loan officer. And they'll give you a closing disclosure 3 days prior to your closing date, and that's by law. And then a final walkthrough is scheduled to ensure agreed upon condition with your realtor. And depending on your state, a real estate lawyer can be used to walk you through the actual closing paperwork, which is scheduled at a title company. And that's where all documents are signed, closing costs are paid, and the title is transferred to you. And once closing's complete, you get the keys and you can move into your new home. So those first steps are really important. And we've talked about working with trusted professionals, and selecting a trusted mortgage loan officer is really the start of that. So in order to get pre-qualified and take that first step, we want to know some questions that we can really use to build trust. So asking them if they hold a personal mortgage license in the state where you're planning to purchase, that's a big one because every lender is not going to be licensed in, like the next question, each state. So asking about where they hold a mortgage license, where they're able to do business is a really good opportunity to understand if they can help you in the areas you're looking to move. Am I free to use a real estate agent of my choice? You should be free to use whatever real estate agent of your choice, but asking them about that is something that can help you build trust. Am I able to call you after hours or on the weekends? Seeing what your communication schedule is like, or understanding that texting may be easier for you or emailing. Building trust through communication is a really great way to feel like they have your back and can help guide you. You can always ask for references. And last but not least, we want to say, are there any fees I need to pay you? Because they're only getting paid when that loan closes. So if they say that they're paid by visit or monthly, that's a red flag. Any additional questions that you can ask related to the loan process, a good loan officer is going to walk through these with you when you're actually going through the process. So how do I handle earnest funds? Or how much is an inspection and appraisal? And what do I need to pay? How do I pay that? What funds would I need to close? Or how will my student loan documentation be used from my student loan company? All of these will be walked through with your mortgage loan officer. But if you want to ask questions earlier on to understand all of the benefits that you're going to get for a physician loan, these are great questions to ask too. Similarly, when we're selecting a trusted real estate agent, we want to be able to ask questions that build trust. So if you're looking for a home or if you're looking for a rental, you can still work with a real estate agent. If you are asking about rentals, you could ask, do you have a team member that assists with rentals if I'm not interested in purchasing? That's a really great way to understand where you're moving, and the community is always well known. Real estate is hyper local, and most brokerages have teams that work with rentals as well as home buyers. You can ask, how many transactions did you close in the last year? There's a pretty funny statistic that came out, and the statistic can be skewed, but in 2025, the National Association of Realtors said that about 71% of active licenses didn't close a single transaction, meaning that 29% of all of the active licenses did all of the home sale business, which is pretty astounding. So if you want to ask about how many transactions a real estate agent has done, that could help understand what their experience level is. And it could also help you feel like you can trust them more with what the process looks like. What's your experience working with first-time home buyers, or even what are the amount of houses that you've sold using a physician loan program or working with physicians or graduating medical students? Letting them know what shoes you're in, can it really help you feel like they're going to guide you to the best decision that you can make? This is one of the biggest decisions that you'll make with the biggest purchase price of your life. So you want to be able to trust this person. Also asking about communication. Can you text them? Are they available on the weekends? Are they available after hours? You may have a difficult schedule that you're moving into, and you need to understand that you'll be taken care of. And are there any fees I need to pay you? Again, a red flag. They get paid when the home sale goes through. So there's no fees that you're paying them until that point. So run away if they say they get paid for meeting you. And now we'll move into, how much do I need for budgeting my closing? And when we look at a closing budget, this is going to be where your down payment, so the total amount of your down payment is, your closing costs, which can be 1 to 3% of the purchase price, varying by state, will be, and then your escrows. Remember, we talk about escrows, where your taxes and insurance are being collected. And these costs are collected upfront to ensure that your escrow account has sufficient funds to cover future payments. So that's 3 to 6 months of taxes and insurance, 1 year of homeowners insurance, and prorated interest from closing date to month end. All of those are subtotaled. And then we've given a good faith deposit, or that earnest money. So we take out the earnest money, which was held in an escrow account, and that's the total funds due at closing. And with all of the funds due at closing, you'll know that amount from your loan estimate and from your closing disclosures. You'll know to the penny how much money is going to be due. And it's always something that you can ask if there are any specific programs for your mortgage loan officer to look at for maybe state or national closing cost discounts, or what type of closing cost discounts you may be eligible for. That's always something that you can ask your mortgage loan officer. Last, we're going to go into a market update, and I'll try to move through this quick since I know we're at the top of the hour. We're going to talk about the FHFA pricing index. So we're back at FHFA.gov, and that website has a lot of information on it about the housing market, but it's a great place to be able to understand what's going on in the markets. And this information is from October of 2025 with the last reported data that's up there. And some of the key takeaways that we see with all of the different regions that are here, we'll see the most regions saw slower growth in 2024 to 2025 than 2023 to 2024. And a few of those regions even experienced price declines. And when we want to think about this, slower growth or declines may indicate that housing markets are cooling, possibly due to higher interest rates or just economic uncertainty. But when we're talking about a housing market maybe cooling and prices coming down, that's actually a step in the right direction for people who are looking to buy homes. So the nice thing about that is that if the market is cooling a bit in some of these regions, there's going to be less competition. When we see the next slide, this is going to be FHFA again, and it's a house price index from all the way from June 1991 up to October 2025. And you can see that housing prices have gone or the housing price index has dramatically increased from 100 to almost 450, where those averages are. And this shows the long-term appreciation of US housing. And I like to show it because it highlights the impact of some of those economic cycles we talked about earlier on in the presentation, with booms or crash or recovery. And it's useful to understand why affordability trends and housing costs are so high today. When we look at April of 2020, this is the steepest increase that we've seen in this chart since 1991. And that's the pandemic housing having low inventory and having just limited inventory with a seller's market. So when we look at how quickly that went up, there's no other time in the history that this has been recorded that pricing shot up to that dramatic. Now we're seeing since 2022 that there's still increases in the pricing, but it's going at a much slower pace. Next, we're going to move to Fannie Mae, which is one of the government enterprises that buys and sells loans. And they do a survey with Partnership for Pulsenomics LLC, which gathers and forecasts from 100 housing experts across industry and academia. And it projects national home price changes over the next 5 years. So you'll see Q4 of 2025 all the way to Q4 of 2030. And the key findings of this survey were that experts expect continued growth, but at a slower pace than recent years. And even the most pessimistic forecast in this still shows prices rising and not falling. So what we want to take away from this is that even though we see doom and gloom in the headlines of when's the next housing crash, what's going on with the housing market, these experts are still expecting prices rising and not falling for appreciation. So going and putting your best foot forward into homeownership, that's something that we want to see and we want to think about becoming a homeowner, because there's appreciation still in the housing market with that expectation. And last but not least, I like to end with why consumers believe their homes are important. And this again is a Fannie Mae national survey. And they explored how consumers' perceptions of the overall value of their home have changed with new needs and utilization, and how changing needs might impact future home buying decisions. And some of the key findings were almost half of consumers say that their home has become more important to them over the last few years. So homeowners consider this being a safe investment, but the non-monetary aspects, like the security of having a home, have really become paramount to them in the post-pandemic housing environment. More than half of consumers say that they've made functional changes to how they use their home in the last few years. So changes including a home gym or growing food, gardening, things like changing your home for hobbies or a home office, working from home. This shows that people are changing their homes for them and their family instead of uprooting and moving to a newer home that might work with that need better, which is different than what past surveys had shown. People changing their homes for them because of affordability is definitely a change rather than buying and selling a new home. And last, although more consumers still say that the security and lifestyle benefits outweigh the financial benefits as the best reason to buy a home, this gap has closed significantly since we last asked the question. And the survey indicates that while financial benefits remain a strong motivator to buy a home, consumers are increasingly prioritizing the emotional, non-financial benefits of owning a home, specifically security, privacy, and stability. And people are buying their homes because it's a home, and a home is what you make it. So that is everything from the survey from Fannie Mae. And again, I do work for a bank, so we do need to go over some disclosures that are on here regarding loan amounts, rates, and monthly payments that were suggested throughout the presentation. And I just want to say thank you. Thank you so much. Here's my contact information again. If you didn't feel comfortable asking a question that was inside of the Q&A that Michael was going over, my email and my phone number are there. And I just really want to thank the AAMC FIRST program for allowing us to come in and present